How we can fix another company. Presentation. Now there's enough question. The presentation. And it was my sit down. Who has been here? Yeah, download also. Hai có cái gì bán mình cần là cái
Move to the next slide. Introduction to tax model analysis. Switzerland Service Limited and Switzerland Service Limited is Switzerland incorporated company, and the Lanka Development Bank is Sri Lankan incorporated company. Lanka Development Bank enter into agreement with Switzerland Service Limited for advisory service. This agreement in between two companies, agreement arise taxation problem. It can be solved with international tax rules in cross-border service. In cross-border, in 2007 number 24, October 24 is non-resident taxation in Sri Lanka. Our key focus is on permanent establishment, income characterization, and distorting tax and double tax risk and treaty relief. After this, contract terms. Terms are US value is $225,000. Duration 7 months. Consultant is stability. Operation details is stable full time on site and NDB in Srilanka. His paid directive include reaching her sales back $16,000. And Swiss Service Limited provide $20,000 equipment for project project use. With the next slide. It's like something.
So in this part of the presentation, I will talk about the stable exposure scope, SSL means Service Limited and the LDDB means Sri Lankan Development Plan. As you can see, there are several tax laws and provisions applicable to this case. First of all, when it comes to the residency, we have consultancy. When we are getting a consultancy service from a foreign company, it will apply to the section 73(1)(j). It means personal services provided by the Swiss company is applicable to the section 73(1)(j). Under this section, it elaborates that any income arising or derived from when delivering services to a Sri Lankan company is liable to pay tax under this section. When it comes to section 76, it's talk about the permanent establishment. Permanent establishment in the sense we have to identify permanent establishment criteria. There are three main criteria to fulfill that permanent establishment condition. First of all, there should be a fixed place, and there should be a fixed place and the actual business, and the actual business should be conducting in that fixed place. So moving to the next slide. When it comes to section 79, SSL's head office expenses only can deduct 10%, and if the profit is repatriated, 14% revision tax applies for the profit occurring from this service providing agreement. When it comes to sections 84 and 85, LDB must deduct withholding tax when paying non-resident consultants. So the Sri Lankan and Switzerland DTA explains when it comes to the Switzerland and Sri Lankan DTA, Article 5 explains the P meaning permanent establishment. It should be met if the non-resident person stays in Sri Lanka more than 90 days in Sri Lanka. According to the Article 7, Sri Lanka tax only profits linked to the Switzerland Service Limited permanent establishment. So Article 13 explains that there is a fixed base because the Switzerland consultant Stephanie stays in LDB's main employees for more than 210 days, according to the agreement. As Ilan previously mentioned, the agreement is for 7 months. Moving to the next article, Article 23. It explains about the double tax avoidance relief. It means Switzerland can grant tax credit for SSL's income when it comes to avoid the double tax on the same income source. Going to the next slide. So when it's come to this case, application to the SSLs, there is we have to test whether it's a fixed base and business control and the consultation and the controls. When it's come to depreciation test, Ms. Stephanie almost spent more than 183 days in Sri Lanka, so it's fulfilled the duration test. When it's come to fixed place, she works full time at LDB's head office, and also SSLs provide the own equipment to carry on her service. even though the LDB provides main services and infrastructure, she is still managed by SSL in their company. So, in conclusion, we can say that both Article 5 and Section 76 is fulfilled according to this statement. From here on, possible continue proceedings.
USP -365 business impact HSL consultancy development and section 73 Sri Lankan source income. Article 7 BPA are flexible, but SSL can deduct USD 60,000 statutory depreciation of USD 20,000 equivalent net profit taxation at 30% corporate tax rate. USD 60,000 refund statutory paid directly by APB into 6 value. Article 11 DPA personal services has a fixed base in Sri Lanka. Representing Sri Lanka for more than 180 cases. Entire amount taxable in Sri Lanka. LDB must report 10% capacity. USD 20,000 equivalent income and capital asset support excellence. On PP, SSL.
You have another 1 minute.
Depreciation equipment to reduce flexible clean profit from a handle motivation. I will be talking about the transparency and recording obligations. Here, there are some duties of SSCL. SSCL must register under permanent establishment with the Inland Revenue Department under Section 76, and also the SSCL must pay 30% corporate tax on net permanent establishment profit. And also 14% of remittance tax under Section 79 unless reinvested in Sri Lanka. And also, Stephanie stayed here for more than 183 days, so she is liable to pay the income tax for Sri Lanka. Stephanie's US dollar 60,000 income is liable for income tax because she is a resident in person. When talking about the LDB's withholding obligations.
You can conclude that.
And we're talking about the double taxation later. According to the Switzerland and Sri Lankan agreement, they have given a tax relief in the form of tax credit to avoid the double taxation for the same income source. Now I will hand over the presentation to Dakshina.
So the last part, conclusion and recommendation. So Ms. Stephanie working in Sri Lanka for over 7 years. So the Swiss company has the permitted establishment of kind of taxable present here. And this lets Sri Lanka tax the profit SSL make from the her works. And also the USD 60,000 paid for Ms. Stephanie is on a Sri Lankan income. LDB must hold the back some money for news. Is the Switzerland will give a tax credit to the SSL, so they won't be taxes twice on the same income. So let's go to the recommendation. So in here, you can see the sum SSL, but I will give some recommendation when presentation for discuss. So the register the Sri Lankan percent and keep the separate records, and LDB needs to hold the taxes and think about the reinvesting and performance. Thank you. Any questions? Audience. Now, let's talk.
So, well, as per the presentation, I feel that you are here and there, that's fine, but I saw that the duplication of the same slide, the same contents, right? Because she also given the conclusion, some sort of, and you also. So it should not be, that's not that is the reason for the you two, there's couldn't manage with the time, right? Percentage. So basically but the expectation is here, the two persons come to Sri Lanka, both are non-residents. One thing is the company. The company and other person is the consultant. So that should be the approach. Both those two are non-resident for the inception because they are coming to Sri Lanka to do some sort of assignment. So therefore, that when they are come to that assignment, how that P is creation on the background, their P is creation. But the ground. So I saw that you have mentioned that branch office and that is it a branch office or not?
It belongs to the LDB. LDB means under Europe. Stephanie stays here to do his her assignment for more than 183.
No, agreement is with the Sri Lanka entity and the Swiss entity. So they have hired another consultant.
Retired,
yeah. Employee that he is not in the employment, right? So she is independent service provider, right? So they have entered agreement with that part. That consultant, that company, the Swiss company sending that consultant to Sri Lanka to do that assignment. Therefore, the assignment, the initial agreement is resident company and the non-resident company. Right? So they are sending their consultant. So how the P is creation?
Because of the she stays more than 183 days plus she is using LDB's main head office for her assignment.
Yeah, so as per that, so at the background, is it the prima facie P or the construction base or how is?
On construction base.
Okay.
Service.
Yeah, it's this consultant because it says that sending or the two, they are employee or other person. Because of that, say there is a P equation. That's fine. You have covered that part, but that is the point, right? So through that there is a P equation. So therefore the permanent establishment level because Swiss agreement what is the duration?
90 days.
9 days. So and the 100 days not the agreement is 7 months. 7 months. So therefore almost that 90 days is within that period. So therefore definitely there is a permanent establishment. Therefore SSCA, the Swiss company, so SSL is liable for Sri Lanka income tax for what?
Because
on what? On the income derived from Sri Lanka attributable to the permanent establishment. So when they are computing that, the profit, can they deduct that what the consultant payment?
60,000 they can.
They can. So can they claim capital gain?
Only 10% when capital tax is applicable for their expenses.
No, that is head office expenses. So there is no, the information comes for the head office expenses. If they have incurred, yes, but there is no, the branch office is created, right? So in the branch office that says that head office expenses we can claim, right? So that is the other point. And other thing is what is this? You have mentioned that remittance tax can be mitigate that exposure. Yeah.
The profit attributable to the PE is reevaluated. So we can we have 40%.
40%. Yeah. Yeah. Okay, fine. So time management is good. Right. So you have to develop some areas need to be developed, right? This is the last chance. The presentation is not up to the expected level. That has to be developed, input. Right? Fine. Thanks. So who's next? Oh. Girls like that. Hey, boys like that. Into that. Huh? I have a girlfriend. I go pay boyfriend. Shakala is finished. Shakala now. Shakala is You can start.
Good morning, everyone. We are doing now the fourth on 17B exception match. Today we are talking about analyzing the Sri Lankan financial gateway of a UK national. Our case is mainly based on Dr. Jonathan Blake. He is retired medical professional in UK. This is our group list. We move to the next topic, background of the case. I already emphasized that Dr. Jonathan Blake is retired medical professional in UK, and he is a UK national. He is temporarily relocated to Sri Lanka for the period of 1 year for conducting freelance medical service in Sri Lanka, and also he is receiving his pension from UK. And he's thinking about other main two investment. First one is investing his consultancy service fund to Colombo Stock Exchange, and second one is after sale his UK property, he's looking for reinvesting his proceeds from SABU account in Sri Lanka. With that, this is our whole case. With that, my part is over. I would like to hand over to continue.
Thank you, Lanka. I would like to talk about the residence tax, the Dr. Blake, and when we come to residence tax, case difficult is divided in the Sri Lanka. And he is satisfied the 183 rule as well as the domestic law in the section 69(1)(b), according to IRA Act, he is the resident of the Sri Lanka. And also, we can say that he is created the fixed base in the Independent Personal Service article according to DTA. And also, he is tax liable for Sri Lanka. His Sri Lankan medical consultation also will continue in Sri Lanka. Thank you, my participant.
We have identified two current income and three expecting income to able to that case. Current income of freelance medical consulting in SF, government pension from UK, expected income of sales of resident property in UK, interest income from foreign currency, CBU account in SF, and dividend income from CAC. Next slide. When considering the medical service income in SF, Article 14 DDA agreement applicable, and also income driving Sri Lanka as per Inland Revenue Act, 13% tax applicable. Over to Priya.
We talk about sale of property in UK. Sorry to article number 6 and it will be taxed in UK because the property is situated in place. Therefore, in Sri Lanka, we cannot Sri Lanka under Sri Lanka law it cannot be taxed. Other thing is mentioned in UK, it's receiving a pension from the government of pension is paid by the public funds of the UK. Therefore, under Sri Lanka law, the pension will not be taxed. Other thing is FCBO deposits. In article number 11, since he is a resident of Sri Lanka, for this year he will not be taxed. It is not exempt. The funds are remitted from foreign currency, it will be accepted. I invite
Thank you. So this is the last income source that he's expecting to invest from his income. So when you come to the dividend income from CSV investments, as per the DTA article 10, it says if we sell the shares, the gains are exempted. And also the dividend is subject to the final WHA that you need the services. So that's all about the. So let's move into the conclusion. But in this analysis, what we have identified is the tax residency is Dr. Dek is a resident of Sri Lanka due to the 183-day rule. And also DTA will apply even he qualified as a resident because between Sri Lanka and UK there's a DTA applied. That's why we have applied DTA. Otherwise, if there's a DTA not applied, then Sri Lanka tax law will be applied. And when it comes to specified income treatment, professional service, that is taxed in Sri Lanka. And UK pension, the DTA guidelines applied. UK property capital gain, it's tax under UK law. But when we calculate his income in Sri Lanka, that UK tax credit will apply when we calculate his income tax. And when it comes to total tax liability, a combination of Sri Lanka tax and India specific options will be applied when we calculate his final tax.
6 minutes. Any question? Question from audience. අතාවල අහගන්නවා ඔක්කොම ලකුණු නැති කරලා ඒක කපනවා සීරියස්ලි අම්කම් ඒක කලින් ප්‍රශ්නයක් කියලා තියන්න ඕනේ ගහනවා කියලා. That's how the presentation happening now. Right, so then fine. So now I mean if somebody is recognized as a resident for Sri Lanka tax, so then why we are need worry about the DTA provision? Yeah.
So that's why DTA comes.
Yeah, you mentioned that what the property, what the it is done UK, what the how the realization gains of the or alienation of capital asset, right? So no, I mean if he become a Sri Lanka resident, so for the UK perspective, he's not resident. Right, so now that's fine. So you have recognized that one the area. So and even the case is very small, that the area is very high, right? One thing is he is practicing in Sri Lanka. He is getting what the income category? Independent professional services, right? So until he reaches 183 days, he is a non-resident. So that particular period is liable for Sri Lanka tax. The rate what you have mentioned is incorrect. 30% you have mentioned because there is it's treated as a fixed base, right? So until such he is a non-resident. Once he become a resident, so even that is coming under the business income, he is a resident. So therefore that but the tax computation you have to show that but that he can get that tax free allowance. Until such he cannot get, right? So that is one thing. So second thing is he's getting pension income. So once he become, yes, of course that DTA apply because now he is a non-resident because for the period he is non-resident to Sri Lanka, he is resident of UK. But therefore that income part is not liable for Sri Lanka tax. Non-resident income, non-resident person, but say until he the registered 183 days, he is a non-resident person for Sri Lanka tax. Until such whatever income received from outside Sri Lanka is because worldwide income is we are considering when he become resident only. Right, until such we cannot. There are after years, but it is still foreign source of income. So as per the Indian law, about the schedule 3, foreign source is tax exemption. That exemption is available to him. Right, even he become a resident. So that's second thing. Third one is disposal of property. If we say that before he become resident, yeah, it is not part of our income. And if once he sold out that thing, after he become a resident, again that we can apply the double tax treaty and the realization is happening and the residency, the UK double taxation agreement is little different. The alienation, especially in the capital gain tax, because the most of taxing right goes to the country where he resident. Therefore, even disposal is happening outside Sri Lanka. If he become a resident in Sri Lanka, it is treated as that tax is applicable in Sri Lanka. Remember. right? But as per the domestic law, that exemption is there. So third one is what is that he's bringing that money and investing, and the even that consultant income is investing in Sri Lanka Bank, FCBU, yes, interest income, we are making payments. During that period, where he resident, non-resident, there's a source in Sri Lanka, but as per the domestic law, that tax exemption is there. Once he become a resident, also tax exemption is there. Right? This both there in the share market investment, there could be two. One thing is realization gain, that is capital gain again. Second thing is dividend. Dividend එක 14 නෙමෙයි apply වෙන්නේ. DTA rate එක apply කරනවා. For 6 months. Thereafter, so sorry, you have mentioned that rate is how? What the rate you have mentioned? 15, yeah. 15 is applied. So 15 apply කරන්න බෑ. Nah. Yes, correct. So therefore that is applicable. So then balance period is anyway that is that. So that's how it should be, right? Right. So then as a conclusion, the recommendation before he become a resident or thing, better to dispose that thing. Otherwise, it could be considered Sri Lanka taxation asset. Right? Right. Paragraph 15, eh? Correct.
Yes.
Right, next rule. Alin. Go product Alin. Oh, yeah, and tax and the rate that's for and get back on that information 14%. They are 3 years, 3% of the Oh. මේක ඩවුන්ලෝඩ් කරලා තියන්න. ඩවුන්ලෝඩ් එකේ ඇති ඔක්කොම ඩවුන්ලෝඩ් කරන්න. උඩ ඩවුන්ලෝඩ් බෑග්. අර උඩ ෆෝල්ඩර් එක. ඩබල් ක්ලික්. 17 එක නේද? And you can start.
Good morning, everybody. So we are a group of 17B extension, group number 6. So our topic is the study under the Sri Lankan Canada double tax activity. Next slide. So these are our group member details. So we took a company, Justin Morgan Incorporation. So Justin Morgan Incorporation, Canadian incorporated immigration company. The branch is located in Colombo, Srilanka. So the main nature of the company is to students, skilled professional and providing immigration solution and training the international migration into reality. So the key services, student visa and work permit. Student visa, this is the background of the company. So now we move how the company under the payment establishment. So since the branch office is located in Colombo, that's very come under the payment establishment criteria. So according to Section 7 of Indian Revenue Act, so which comply with the PE. So that's the reason we consider the Colombo office as a permanent establishment. Next one is double taxation. So what are the possible income earned from Colombo areas? One is interest, dividend, business profits. So by Article number 7, state about the interest. Article number 10, dividend. Article number 11, 7 business profit, 11 interest. So like move to next step. So which will explain.
Here I'm going to at Article 5 how Megan gets in various branches become a permanent establishment according to double tax agreement between Sri Lanka and Canada. They in case they have branch and they managing the place of business as an office. Therefore it becomes a permanent establishment. Next I'm going to brief their taxation area that's impact in article number previously you heard in article number 7 describe how to provide for every attribute to permanent establishment, and there in state even there is scenario has head office has invested to build to branch office as a management fee. Then in this case we treated as it is a technical service fee. Then there is a type of transaction as royalty. Then we think this comes to be going to article number 17. How royalties in taxes. In that case, article say that some royalty was related to other contractor states, both countries pay tax, but it will be limited to the 10%. And otherwise, if there is no DTA, it was taxes should be paid regular taxes 14%. This is the example question. How we arrived at the tax computation. There is 1 million revenue, and this is assumed figure. If there is local expense in 300K and profit calculated to 700K. In this case, management fee as a notable expense. The profit was calculated on that 700K profit, and management fee will be separated tax on 10%. Other taxes in prevailing tax law as the prevailing tax law 24%. I will hand over my presentation to Hasi. So, companies providing management consultancy fees such as the business development support, strategic planning, and management oversight. So, when providing one of the tax principles is to check whether these are in arm's length, that is getting a transfer pricing. Because by providing at a low cost, the ERD is getting a low tax rate. So, it will be at the market rate. So the simple meaning is the transaction between two related parties should be considered like it is happening between two independent parties. So this is there in section 77E of the IRC Act number 24/2007, and also in article 9 in the double taxation act between Sri Lanka and Canada. So it becomes an associate enterprise according to article 9 when one enterprise in a country is directly or indirectly controlling the other enterprise. Or maybe the same people control enterprises in both countries directly or indirectly. So deductibility of management fee. So according to how the Dusan said that the 30% of management fee cannot be deducted, basically because it is invoice. So next I would like to hand over to Pal.
Thank you. Now I would like to how the local tax treatment in reinvestments. Here reinvestment by a permanent establishment paying in Sri Lanka is taxable under section number 52 of the 11A, even if retained within the country.
Here I have mentioned how this company has applied these treatments in the reinvestments. This one, this moment, launch must pay corporate tax typically at 30%. If it is a qualifying for install, then it should be 15%. Then there is no tax unless the reinvestment qualifies under board investment BOI schemes. Additionally, reinvestment in capital asset does not reduce taxable income immediately. Instead, deductions are allowed only through the depreciation over 3 to 20 years. Next, the DT impact on the reinvestments. Here, double tax agreement between Sri Lanka and Canada plays a key role in shaping the tax implications of the law. As per the Article 7, it ensures that the profit attributed to PER tax only in Sri Lanka, while the Article 10 there are 5 prevents Sri Lanka from imposing additional tax on within the next taxation. As I mentioned here, the key point is not is reading of officers sheets from tax, which is always 14% of the so means the income which for business or individual which obtained from the first countries for the however, if the profits are less distributed to Canada, a 10% withholding tax applies on the article. Also, the DTA also restrict the deduction for non-arm's length payments to the SOP. The enforcement is for arm's length and this is based on the interest rate we were interested. And now I would like to go to Jason to contribution.
Under this contribution part, Justin Morgan's tax situation with the Canada and Sri Lanka double tax agreement. The company is qualified, company branch is qualified as a permanent establishment under the article number 5 of under the article number 5. So that means that the profit is taxable in Sri Lanka and the management fee that paid to the Canada, Justin Morgan Canada, that is liable under the article number 12 of treaty, that is liable for the 10% of the WSC. So these are the key findings of this DDA provision, and when it's come to the compliance and consideration, the main details, transfer pricing documents to substantiate the arm's length nature of the management consultancy fee and the withhold and the remit the correct Sri Lankan tax of 10% W on the fee, as I said earlier, to avoid the penalties and interest. So retain all the service agreement invoice and proof of the service delivery from the Canadian head office also consider as a compliance. And when it's come to these Justin Morgan branch, if the management fee is taxed at 10%, they will reimburse the profit in Sri Lanka rather than taking out from the Sri Lanka. So that means the one keeping inside the Sri Lanka and they will reimburse on the technology and these other development funding the company. So that's all.
Any questions? No questions? Huh? So I mean, very practical. I mean, the case what I give, that's what Justin Morgan is. They are doing that visa facilities for the Canadians. I mean, the opportunity they are promoting in Sri Lanka. So yeah, fine. So I mean, no need to worry about whether there is a permanent residence or not. Why? Maybe they are telling that is the case. It says that they have a branch office in Sri Lanka, so it's a permanent establishment. So you have to recheck that. So we get the prima facie permanent establishment. They have fixed business location in Sri Lanka. So good that you have given an example and how to compute and all those things. But so 22-23 is not the year what I am expecting here. So is the hiding behind that factor? What is that? So they have started business in Sri Lanka 22-23. They are keeping reinvesting money in Sri Lanka for the expansion of their business. They are expanding the business. That's what they say. They want to enter the South Asian market. Therefore, they establish branch office in Sri Lanka. Thereafter, they are going expansion of their business. We invest there in money. So find that they can gain capital as a sales over a period of 5 years or whatever period. That's also there. Apart from that, they are not liable for remittance tax because they are investing in expansion of their business. 22 ඉඳලා මේ වලට අවුරුදු 3ක් ගිහිලා. That 22 period එකේ tax එක එන්නේ නැහැ ඒගොල්ලන්. That's what you have to highlight. Right? That is the one thing. That's the main area what I expect from this. Yeah. They can take the 22-23 profit back to their Canada without paying remittance tax. Keeping investment of Sri Lanka because expansion of business. So the management fee they cannot be done. That's the other thing because they are expecting to charge some management fee to Sri Lanka branch. As per the DTA, when you work out their business profit, they pay business profit, right? Business profit. Reinvestment means they invest in the same business, not the external. I mean, they just like no bank deposit, nothing. They are investing, keeping investment on, no, they retain the profit in Sri Lanka and keeping expansion of the existing business. That's what it's about, right? Okay, fine. You are within the period and time period also you manage and contents also good. Number 78, right? You will presentation 78, right?
Number 70 should know.
What is the group number? 4. Presentation 4, right? They can start.
Good morning, all of you. So first of all, I would like to thank you for giving us the opportunity. So today we are here to inform you about how the non-resident and resident tax exposure in when it comes to the Sri Lankan context. So we took the YCL company as the case study. And within a short time of period, we hope to cover what's the brief introduction about YCL and double tax avoidance agreement, permanent establishment, income classification, tax liability, and overall control. So let me give a brief introduction about the company. So we got the YCL company, which is incorporated in Romania, and it is a high-tech construction machinery manufacturer. And there's no legal presence in Sri Lanka. With the time, they wanted to expand their business to Sri Lanka as well. So because they don't have any legal presence in Sri Lanka, they wanted to came up with a business model So with this business model, they have four key strategies: sales agreement, local sales provision, commercial terms of trading, and technical support. Under sales agreement, they directly do the contract between the customer, which means the agreement executed outside of Sri Lanka. And when it comes to local sales provision, they came up with a local company which is incorporated in Sri Lanka, which is called as YLCS, York Lanka Construction Services. And it is prohibited to provide services for non-YCL customers. And when it comes to commercial terms, the YCL reimburses the cost plus 5% markup at $20 USD from YLCS, and they charge $30 from the customer. And the training and technical support, YCL training the YLCS employees, and then YCL provide instruction and manuals, which is needed to provide after support and the installation part. And then the question arises because YCL is incorporated in Romania and YLCS is incorporated in Sri Lanka. So there might happen a double taxation risk. So because of that, Sri Lanka and Romania has a double tax avoidance agreement. So Amash will explain briefly about that.
You want to ask the yes, double tax avoidance agreement of Sri Lanka and Romania. This was established in 1984 and this was implemented in 1986. The main objective of this agreement is to avoid double taxation effect of two countries and increase the international sales and avoid tax evasion. The framework, this agreement provides a framework of income sources such as capital gains, royalties, and business income. This double tax avoidance agreement explains about some mitigation activities such as credit limits and also mutual agreements in order to avoid tax evasion within this agreement. Next, move on to permanent establishment. This double tax avoidance agreement and permanent establishment. When it comes to our case study, YCL Romanian company is established in Romania and other company, York Lanka, is established in Sri Lanka. So Sri Lankan company is taxed from Sri Lanka according to Sri Lankan law, and Romanian company is taxed in Romania because Romanian company is established in Romania and it has a permanent established in Romania. And Sri Lankan company is earned profit attributable to the Sri Lanka is taxed in Sri Lanka, and this is when it comes to the transferring the profit to Romania, 40% tax is taxable. The methods of eliminating double taxation here, extension methods such as mutual agreements and credit limits, as I explained earlier. Next, permanent establishment bill, further explained by John.
Permanent establishment. It is a place of the business in which are the business of the employees is wholly or partly carried on. As example, for the under the Sri Lanka Romania Double Taxation Act, Article 5, your office, factory, workshop, branch, or construction installation project more than 275 days. These are it has permanent establishment. Then analyze the PE, York Lanka and YCL LCS company. Then YCL Romania is non-resident in Sri Lanka outside the territorial boundaries. Then no legal business presence of the Sri Lanka. Legal presence of PE in Sri Lanka. The machinery manufactured in Romania sold via the contract signed abroad. The profit are taxable only the Romania unless the PE exists in Sri Lanka. The York YLCS Sri Lanka. Sri Lanka, it is Sri Lankan incorporated company provide installation services. Risk of independent agent. The exclusively YCL employee training and operations control. They can't. They do not provide the services other clients. The Sri Lanka can tax profit attributable to these PE Now measured sales. Now, third part is income classifications explained by the Himesh. Over to Himesh.
Income classification for YCL. Uh, YCL earns income from three main sources. In first one is business income, sales of machinery made in Romania and shipped to Sri Lanka. These sales are only taxed here. If YCL has permanent establishment, which is explained in double tax arrangement section 5 and section 7. Second income is service. The installation and operational works done by YLCS inside Sri Lanka, because this is done locally. It's fully taxable in Sri Lanka. Third income is technical service fee. Like train, manuals or technical guidance YCL give to YLCA are considered royalties or technical fees and so in Sri Lanka. They may be subject to WST unless reduced or exempt by next part will discuss
Okay, thank you, Dimesh. Next part, tax liability of your consultation DD. From this topic, I would like to explain about how much they need to pay as a tax. So, as a permanent establishment, under India Revenue Act 24 2072. 2017, under section 62, it's applicable for when non-resident earns profit in Sri Lanka via PE. So it's YCL, it's earned profit through the YCLS by providing services and get the profit. And after deducting corporate tax and the rented corporate tax, they are sending for the rented profit to Romania. And then again, it's tax. So here I have mentioned the example. This is 10% USD 10 profit derived from the when YCL do some project, they have charged 30 USD and 20 USD for YCLS as a service charge. From that 10, they have one profit. So let's assume they have done 1,000 projects. So they earn 10,000 USD profit tax. So after deducting corporate tax as 30%, they have post tax as a 10,000, so 7,000, and that's 3,000 is their income tax. So rental tax charged from the post tax profit. So 7,000 into 14%, that is USD 980. Then their total tax liability USD 3,980. That's come from corporate income tax and rental tax. So other than that, they have.
You have another 1 minute.
Okay, I would like to call Avishkar to conclude this.
So yeah, as we have discussed, there is a risk analysis where there is a high chance of P status being applied. Am I audible?
Yeah.
Yeah, high chance of P status being applied as the YLCS is working exclusively for YCL. There is heavy tax cost as well, and there is the risk of transfer pricing where the 5% profit margin will be challenged, and also the VAT risk where if they surpass the thresholds, they will be charged VAT. So if we give recommendations for them, it would be a great idea for YCL to let YLCS take some small projects for other clients to show its independence, and to defend the 5% markup price. It would be good to gather local price codes as evidence, and they should also manage VAT proactively. they should monitor turnover and register before hitting the thresholds. And also, when giving their technical services, they should bundle into their main contract price to avoid extra withholding tax and so on. So we would like to conclude our presentation with this. Thank you.
Any question? So guys, whether one question, whether there is a permanent establishment or not? Under what ground? So YCL is
independent agent of Sri Lankan company is independent agent of the Romanian company. So it has
which company?
YCL is a Romanian company. YCL is a
Sri Lankan company. So that is subsidiary and what everything?
It's an independent agent. Independent agent of YCL.
Independent agent.
independent agent.
Dependent agent, correct. Dependent. So that is the one. So no, how that? So two other thing you have not mentioned because they have incorporated another company in Sri Lanka, right?
The Romanian company provides installation and other repairing activities to Sri Lankan company. For the machinery, creation of machinery.
Now there are two type of things. First thing is they are manufacturing machinery outside Sri Lanka and they are finding customers in Sri Lanka. They are sending that machinery to Sri Lanka. So the entire agreement is happening outside Sri Lanka. So therefore, that income what they are getting from Sri Lanka because it is not liable for tax in Romania. Right? It is liable for tax in only Romania, not in Sri Lanka. Right? So the other part is they have appointed a person in Sri Lanka. But they do only installation part. Right? So from that, the Sri Lankan company that is anyway resident company in Sri Lanka. They are liable for their profit on that. With the Romanian company is liable on that profit.
Profit earned in Sri Lanka is liable for Sri Lanka.
What profit?
Service income.
Service income. So then installation service done by Sri Lankan company. Part of that thing is liable. The Romanian company also liable for tax in Sri Lanka. Two things. No? The first thing is they are manufacturing machinery sent into Sri Lanka. That is one risk. Second thing is they provide they are appointing a Sri Lanka company to provide installation service. From that service also, Sri Lanka company is getting some sort of income. On that income, part of that income is liable for tax under the Romanian company in Sri Lanka. Right, that question is correct. Clear? My question is, there are two types of transactions I could find here. First thing is they are selling goods to Sri Lanka. Second thing is they have appointed a company in Sri Lanka to do some sort of installation service. From there also they are getting some sort of income. Whether that income is liable in Sri Lanka or not.
Sri Lanka is according to Sri Lanka.
That's right. So I mean that is Sri Lanka company or there's separate company in Sri Lanka. A company is liable in or the Romanian company. What is Sri Lanka company liable? Why this so? No, that's floating. So I mean that's one thing is they are sending that machine to Sri Lanka. And that also they are earning profit from that. Actually, that machine to Sri Lanka customer. They are earning profit. Right? That's one. Second thing is for the installation part, they are going to Sri Lankan company. Through that, they are charging some fee. They are keeping some money and they are balancing they are going to Romania. So on that activity also they are earning some profit in Sri Lanka from Sri Lanka. That profit is liable for Sri Lanka taxes. Not only, I mean, repaying the profit. So my question is, so they are doing two type of, I mean, they are getting two type of income source from Sri Lanka. First thing is selling goods to tangible goods to Sri Lanka. Second thing is they are providing some sort of installation services through Sri Lankan entity. On behalf of the remaining entity, Sri Lanka entity is providing that installation service. That's how it's happening. So on that they are getting some income. Even part time people are going to Romania. You can find action other Romania tax. That's the question.
Because Sri Lankan companies independent agent of Romanian company.
No, you told that dependent agent.
Independent agent of Romanian company. So the something which is by Romanian company through Sri Lankan companies tax.
Lanka tax and Romanian company. On that profit.
Not Romanian. Sri Lankan.
It's not clear. And you are almost there. You have highlighted that part. So we are going to so one thing is they are selling goods to Sri Lanka. On that profit, they are not liable to Sri Lanka because contract is signed outside Sri Lanka, settlement is outside Sri Lanka, therefore that profit is not liable for tax. Second thing is they have appointed local company to provide installation services. Right? The installation services ke Sri Lankan company is charging some fee. Again, part they are paying to Romania company. So that Sri Lanka company is a dependent agent of Romanian company. Why? They are restricted. So you have highlighted that restricted to do any other business other than the Romanian business, and all the technical support to do that business is provided by the Romanian company, including training of employees. Therefore, Sri Lanka company shall be considered as a dependent agent of non-resident person. So therefore, the profit attributable to the there is a permanent establishment there. Agency-based permanent establishment is created. The profit attributable to the permanent establishment is liable to Sri Lanka. Sri Lanka company is a common tax because it's a resident company. So just because of that, I mean, the relationship it doesn't need a permanent, but because of the dependence agency, there is a permanent establishment of YCL in Sri Lanka. Right? Therefore, the profit attributable to the YCL on the service provided, installation service provided in Sri Lanka, they are liable for tax. Is that clear? That's right. That is 4, right? Time 16.
Today we are going to present about tax implications of circular India Private Limited. These are our members. We are both that's in the introduction part. Circular India Private Limited is a multinational company. They are engaged in construction equipment business, and they are recently planning to engage with Sri Lankan business. So in this talk, we have evaluated the India Private Limited based on resident status of the company and the applicability of the Sri Lankan and India ETA and income recognition and the strategic tax planning. So when we evaluate this company, they propose four models. One is green model, second is sales model, and branch office model, and the dealer model.
My part is lease model and sales model. When in consideration of the lease model, machinery is from the Singapore to Sri Lanka, and they are into lease agreement with the Sri Lankan customer. And with consideration of the residential status, there is non-resident in Sri Lanka, and the consideration of the non-physical figures and non-fixed places in Sri Lanka under DD. And tax exposure also no Sri Lankan tax liability on the business profit due to DTA under DTA. And when these are the withholding tax obligation may arise from the royalties, which means fees. And second one is the sales model. Scheduling the sales measured to Sri Lanka. And from closer see Sri Lanka source, and when consideration of the PE consideration, there is a non-physical officers and fixed places of the their business under DTA. And taxes also been not profit taxable in the Sri Lanka due to DTA agreement. I hand over to Ramsha. Thank you. Let's talk about branch of the model. It is not SIL set up registered branch in Sri Lanka to conduct sales activities, royalties or rentals of the entities. Then talk about key aspects of this model. First, permanent establishment. The branch automatically considers under both local law and BDA Article 5. Then we have tax liability. Branch treated as non-resident, but it is still taxable because any profit arises from Sri Lankan operations are taxable at 24% of corporate revenue. Then regarding additional obligations, branch profit tax PPT 14% are required to pay on any profits sent back to the head office. Also, transparency compliance are required for all transactions in between branch and head office. Then we have income categorization. This income is business income. Any royalties paid to the head office is subject to the 10% of WHD. Then, as you can see, first diagram shows the permanent establishment by model. The branch model has the highest rates, permanent highest rates, which is the score 5. Then we have estimated Sri Lankan tax exposure, and it has 100% tax exposure in Sri Lanka. Then this pie chart shows the tax exposure distribution across the model, and it has branch model has the 60%, 62.5. In short, the branch model has the highest permanent establishment risk and estimated Sri Lankan tax exposure. Under article number 40. They are providing after service and after selection trainings and post-grad basis. And move to the tax exposure and income. There is taxability under Article 7. So There is the government establishment under this. There is a proper documentation for this company to ensure income tax like then we analyze these models. From this model, there is no permanent establishment and no there is DTA protection. So no tax exposure to under DTA is one. Then sales model. There is no risk and there is no tax exposure. In the branch model, there is permanent tax location and there should pay tax for branch income. And there is the single establishment. There is a dependent agent permanent establishment, and there is a tax exposure.
Thank you, Rashidi. I would like to explain total investment income housing applicable in the double tax avoidance agreement between the India and Sri Lanka. In business profit in and permanent establishment is described in Article 7 and is profit taxes resident in home country or unless the permanent established in other country, it's based on tax in business profit and also its place of permanent establishment. It also the impact to double tax agreement and agency permanent establishment also the dependent agent action on behalf of the other country, other resident, and also there is the separate enterprise principle in there, the permanent established as an independent entity. In aforesaid the Rashmi, the model 1 and 2 is meaning only for the India tax, and also in model 3 and 4 it's allowed to Sri Lanka on tax because of the permanent establishment in our country. In investment income is explained by the Article 10, 11 and 12. In dividend, the Sri Lanka also paid dividend on behalf of the India. The Sri Lanka have maximum limited to rate of tax in 10%, and also interest also in there. If interest is if the recipient is beneficial of the country, they have to pay tax in maximum rate is 10, and royalty also in India taxable at maximum limited to 10%. The article are crucial for intercompany transaction loans and also intellectual property equipment usage like royalties. Next, I would like to what are the eliminating double taxation and strategic recommendation. The method for double taxation avoidance are used for exemption method and credit method. Exemption method are using Sri Lanka income tax on Sri Lanka.
1 minute. You have 1 minute.
Okay. And credit method also credit linked to Indian tax rate. India also usually use the credit method. And additional double tax settlement articles are the Article 12 or 12A, fees for technical service, cover payments, and contra payments, and also Article 13, capital gains. If they are effective in Sri Lanka, they have to, if they are sales they are effective in Sri Lanka, they have to pay tax on behalf of the Article of 13. And Article 14 and 16 also the personal director services. I would like to hand over to Tim to conduct our presentation. Thank you.
And this is a recommendation for your companies to further model 1 and 2 the sales model is important tax exposure and full DTA protection or the market testing, and second one is avoid the creating permanent exposure. Calculate of separate outside from Sri Lanka, avoid the economic tax for these projects and branches 3, 4 electric. And moving to the next slide. Plus financial inclusion is Sri Lanka by intervention, Sri Lanka is the tax process and finally determined by the permanent establishment
The model 1 and 2 litigate based on assumption and from Sri Lanka export avoiding perfect stress is the and model 3 and 4 branches the dependent legal trigger the taxable process and balancing the strategy with the taxing efficiency and balancing the and final recommendation is to consider the advanced loading from Sri Lanka Institute Department for
So, yeah, so go to that tax computation part, that presentation. Oh. Yeah, so what's that, 24%? 24%. So tax level branch treated as non-resident but taxable. Profit attributable to Sri Lankan operation now taxed at 24% corporate rate. What is that?
For their local business, there is a corporation tax.
Yeah, well, anyway, the branch can be considered as I mean, it is definitely a permanent establishment now. So then there, it shall be considered as separate entity. Therefore, the profit attributable to the branch of its liable for Sri Lanka tax and spot trade. The rate. 30%. It should be 30%, right? Other things are correct. This one. So don't use that if what is this other one? Likely. Because it says likely that dealer can be considered as a anyway dependent agent. Why? They have the technically dependency. Dependent agent. So it's not likely that it is permanent establishment. So other one, no, go back. Other one. So that you have mentioned an if permanent establishment. No, it definitely becomes branch office is the permanent establishment, right? So okay, under the dealer model, so they are importing machinery from Singapore, right? And it is, I mean, the sales are made to Sri Lanka, but transaction happening outside Sri Lanka. So selling of machinery is not liable for Sri Lanka, right? So here the other part is anyway that even that SIL is doing, but then installation part and all those things in Sri Lanka, it is still non-resident person. Then we are doing fee payments to outside Sri Lanka by a non-resident person. Even that to another non-resident person, that is also subject to tax. Other things are fine. Who else? Better. Yeah, and independent person services underneath the fixed base set. Fixed base එකනේ යා කියලා ඉන්ෆර්මේෂන් දෙලා නැති. ඒක කියනවා එහෙනම් යා අපේ ලන්ඩන් එකේ ඉන්නේ අනිත් යනවා නම් නෑ ෆික්ස් බේස් එකේ කියන එක තියෙන්නේ ෆික්ස් බේස් එක පේට කරන නම්බර ඔෆ් බේස් හදන්න. යා ඒක මාසෙකට ආවත් ඇති. ලංකාවේ යාට දෙනවා රෙගුලර් බේස් එකක් ඩෙවලොප්මන්ට්. just like France. එහෙම නැත්නම් තමයි මොකද ඒක අඩිෂන් දෙක තමයි ෆික්ස් බේස් එකක් තියෙනවා රෙගුලර් එක. ඊට පස්සේ එකක් තියෙනවා 180. එදේ පාස්. so අරක දෙන්නේ සම්පූර්ණ දාලා. Get is you asked him to retire from there and he came here under this visa, that visa and that. Now I'm visiting with my name. Yeah, I am in time. Income capital of maybe registered as monthly income can I not registered university. Here number of members of parliament is low like but then case law, case Contract sign officer. India agreement
Thank you for being here again. So, this is our presentation topic, double tax analysis of Sri Lanka, Vietnam, introduction of collaboration. This is our table of contents. Before the start of the presentation, let me introduce some group members. Ashim, Nanda, Taruka, Derinti, Taruka, Rishika, so background of the project under the Sri Lanka National Transport Plan to USD $500 million. Especially it's very territorial protection to improve connectivity and support the long-term economic growth. So parties involved, there are parties involved in the construction agency, which is the Sri Lankan company. They are converting the contract and partnering with logistic network Vietnam Corporation. Yeah, this is the Vietnam company. And Asia and Bangalore. So there's value is US, total value is USD 250 million. They actually can't say nearly USD 180 million for offshore designs and fabrication and shipping of components. And actually to say USD 70 million for site supervision and technical advisory in Sri Lanka
includes 100 days. So our purpose is representation analysis to access the LNVC's tax liability under the International Act number 24 of 2017 and Sri Lanka getting on double taxation and determine Sri Lanka's source income and evaluate partnership establishment status and establish the tax obligation and consider low level tax indication. So now moving to the
Today I'd like to explain the level of establishment evaluation for the LNVC company. According to the double tax avoidance agreement, article number 5, a permanent establishment can be defined as a permanent office, branch, or any other kind of service that provides more than 110 days in Sri Lanka to establish a permanent to be established as a permanent establishment. So in this LNVC agreement, the agreement between LNVC and NT Constructions, there are two agreements we have. The first agreement was the manufacturing and the designing of the products or the parts of the construction parts in their country Vietnam. So the cost of production is the 100% of the production is done in outside the coast of the Sri Lanka, Vietnam. So there will be no fee will be created in the agreement number 1. But when we talk about the agreement number 2, there is a 110 days they have worked in Sri Lanka for the consulting of the construction process. So as per the DTT agreement, article number 13, clause number 1. So to establish a permanent, to be established as a permanent establishment, they are used to work as 183 days to become a permanent establishment. So they have worked for 110 days. So there will be no PG created, but they are charging a 70 million consultation fees for their construction, which can be charged article number 13, maximum of 15% for their services. That is the only tax implication. The tax implication given to the LNVC company. For the next part, Lanka.
Sources. Then have 3 elements. Identify the income and service income and employment income. And everyone 1 identify business income and then 2 identify the service income. Income. When Sri Lanka source Sri Lanka corporation is more than 183 days pay for the Sri Lanka permanent establishment, they have to Expansion about the tax liability tax liability of the Sri Lanka because tax liability means the simply taxable amount a person or business has to regard to the government. If we talk about there are 2 agreements between the Vietnam company and this company. If we talk about the agreement 1, in the agreement 1 they are doing the whole process in Vietnam. So that's defined as a business income, and they are charging 180 million USD for that. And if we talk about as per the section 73 Act number 24 2007, they are doing all their process in the Vietnam country, so they are not liable for tax. And for that, there is no withholding tax deduction required. If we talk about the agreement number 2, they are coming to our country and doing the technical service related works in 110 days in Sri Lanka. They are charging USD 70 million for that. As per the section 85, they are coming to our country and doing this whole process in our country. So they have to direct, so they are charging withholding tax 14%. For when they are paying the amount, they will deduct the 14%. That means 9.8 million, and they have to pay. If they pay this amount, they have to pay. They have to calculate the exchange rate on the payment date, and they have to deduct this amount. The next part will be the budget.
Yes, Altaf. So this slide is about whether the Vietnam's employees of Logistic Network Vietnam company have to pay tax in Sri Lanka. They came here for 110 days to supervise the installation of modular road components according to Section 73 of the Inland Revenue Act. If you earn income by working in Sri Lanka, that income is considered Sri Lanka sourced no matter where you actually get paid. The residency rules say if you say 183 days or more in a tax year, you pay tax on all your income worldwide. But if you stay less than 183 days, you only pay tax on the income you earn in Sri Lanka. Since these employees stayed only 110 days, they are non-residents, but the money they earn for work done here still taxable in Sri Lanka, even if it's paid in Vietnam. Now looking at the double tax avoidance agreement between Sri Lanka and Vietnam, Article 15 says salaries are not taxed in the employee's home country if three considerations are met. One, they stay less than 183 days. Two, they are paid outside the host country. And three, the salary cost is not paid by permanent establishment in the host country. Here the stay was under 183 days, but there was a Sri Lankan permanent establishment because Logistic Network Vietnam company had a 110 days supervisory presence here, and the salary cost was paid through it. So because of that permanent establishment, Sri Lanka has the right to this income under both the Inland Revenue Act and DTA. Thank you. Next one, Devmini. Over to you, Devmini.
So I'm going to about the tax application of the Construction PLC. As in Construction PLC is a Sri Lankan operating company issued under the Sri Lankan tax law. So according to the applicant number 1, there is no importing tax as it operates entirely over the offshore land. As per the agreement, it will have been 40%. So 40%. As the Sri Lanka and Cuba consultation. Supervisory and installation service. So for the compliance engineering construction and also issue certificates for the Vietnam company to take the tax credit, and also they should of course keep the documents and the contracts to show the optional nature of the agreement number 1 and to the source of Sri Lankan show the withholding tax of Sri Lankan source in the agreement number 2, and also they should apply the provision provision correctly to obtain the tax residence certificate of the Vietnam country. So, like for the for the concluding and recommendation of here is the overall conclusion and recommendation for LNBC. Maintaining documentation showing the absence of fee in Sri Lanka, employees travel and project timelines. Second one, keep separate financial reports for agreements to
Finish that. Time is over. Right, no, okay, so then fine. So let me know, so I mean you have go back that presentation or slides. Yeah, hold. So and that there are two agreements, right? One is for what?
One is for the.
No, let me ask a simple question. What they are doing in Sri Lanka?
They are providing construction services for Sri Lankan NDC.
Yeah, what happens is Sri Lanka government has put a agreement on the construction project to Sri Lankan companies. They have given that to subcontract to Vietnam company. So what the Vietnam company is doing, they do the structural and everything is outside Sri Lanka. Then they are taking back that item Sri Lanka. They are going to install in Sri Lanka. So the two part, right? Two agreements. So what they are doing, first thing is to do the the design and manufacturing of that part. Second thing is installation. So first part is whether they are liable to Sri Lanka tax or not. No. Second part, liable on what? Okay, so what? Whether there is a permanent establishment created or not?
Establishment created.
Created.
No
created. Why?
Because they have worked less than 183 days. That's why on that basis.
Have you gone through the detail Vietnam and Sri Lanka?
Yes.
And in which category this is coming? Article 30. 50.
As per the section 85, they have the only tax code.
So that is section that is 11 or no? So I'm asking regarding the article.
Article number 5.
Number 5. So what the number 5 is saying?
Establish a permanent establishment. They have to have a branch office.
Yeah, that's the first thing is remove AC. Second thing is
who says providing any kind of consultation
yeah
for 90 days, they will be created a PE.
Yeah, how many days they are staying in Sri Lanka?
108 days.
It's more than 90 days or less than?
More than 90 days.
So then whether there is a permanent establishment or not?
We have to comply with term 1 and 2. Both have to be compliant to have the fixed place and also.
They don't have fixed place, correct?
But they only the transportation part and installation part.
Yeah.
That process they have more than 139 days, but they don't fulfill other requirements.
Which other requirement?
They don't have fixed
Education or
Is it required? That's true, right? Because in that that I refer to the tax evidence agreement. In that say the term permanent establishment likewise encompasses building site, the construction, assembly, or installation. What they are doing? Installation. Project, building supervisory or that blah blah, but only where such site project or activities continues for a period more than 90 days. Within any 12 months period. So they have doing installation part in Sri Lanka. So in that context, there is a permanent establishment. Your basis is wrong. Because permanent establishment means first thing is says if they have a fixed business location in Sri Lanka, yeah, definitely it is a permanent establishment. Thereafter, it says these things are coming under the permanent establishment. What is that? A place of management, branch, and office, factory, workshop, mine, oil, warehouse, installation, structure, so that type of thing. Right? That is used for the exploration of natural resources, that part. It is not natural resources. Third para says permanent likewise encompasses the building site. That is construction based fee. Installation assembly that is covered. Therefore, agreement number 2 under that, what they are providing here, installation part, that is also coming under the permanent establishment. So therefore, profit attributable to that part is liable to Sri Lanka tax. Right? Make that correction and do that. So that part is wrong. The other part is you have covered that, but if they are employees in Sri Lanka, yes, they also liable for Sri Lanka tax, unless the conditions, 3 conditions are not satisfied. Right? Okay. That is 8, right? ඉගෙනනවා නම් මේ වස්තුව. ඒ කියන්නේ බ්‍රාන්ච් ඔෆිසර් කරනවා ප්‍රැක්ටිස් වලට අඩුවෙන් කියලා පර්මනන්ට්. එතන එකක්වත් නැහැ. එතන කවෙන්නේ නැහැ. එයා ඉන්ස්ටොලේෂන් මේ ඕනේ ඒකත් පදයක් තියෙනවා. ඒක නෑ දැන්
It's fine.
Good morning to all of you. Our topic is tax exposure analysis of Best Management Incorporation under the Sri Lanka, France DTA and Inland Revenue Act. So let's move on to another slide. This is our group list. This is our outline of presentation. And let's move on to introduction. Best Management Incorporation, BMI, a French company offering information technology services as a consultant, collaborates with CTS to launch serving in expanding to Sri Lankan on the line of development on a contractual basis of 6 months, and the contractual value is US $250,000. This joint venture leaves tax exposure concerns of BMI in Sri Lankan, Inland Revenue Act, and the double tax avoidance agreement with France. This presentation discusses possibilities of creation of a permanent establishment, classification of income, and statutory liability under the Sri Lankan tax law by BMI. Let's look at tax residency and source-based taxation. Being a French resident under the DTAA, BMI is not totally taxable in Sri Lanka on its worldwide, but on the income sourced in the country. The Inland Revenue Act in Sri Lanka is confined to source or arising of income with the state not exceeding the tax obligation on non-residents. It is important to conduct assessment of the tax exposure of BMI due to arrangement with CTS in the terms of taxable persons in Sri Lanka. So therefore, our main key question is, does this arrangement create a taxable person? It means PE in Sri Lanka, and if so, what income is taxable? So that's the end of my part. I will hand over presentation back to Chanika. Thank you.
Service fees, providing the market and market research service. Is flexible on the as the part of the As per the regulation, it's not in service fee is an understand, but it's from here here just the same. It's so what that it's on occasion and it's central over it's CPS is responsible for creation and corporate action. And in these ones, it's not only in Srilanka, and that's not the cost and on the from the so all established between current
Naomi, can you hear me? You are done. Hello. Hello.
Hello.
Yeah.
The Regulatory Act 24/2017, the Act taxes on Sri Lanka. The Section 195 the international standards in provision of tax law. PMI must estimate
Thank you, Naomi. So I'm going to future tax risk and explanation considerations in Sri Lanka. If BMI were to open an office or subsidiary in Sri Lanka, it would become liable for full local and corporate taxes. So this would also can anyone hear me?
Yeah, now we can hear you.
Oh, okay. Thank you, Naomi. So I'm going to talk about the future tax risk and explanation consideration in Sri Lanka. If BMI were open to an office or subsidiary in Sri Lanka, it would become liable for full local and corporate taxes. So this would also mean mandatory registration within the Inland Revenue Department, compliance with transfer pricing rules and submission of regular tax returns, all of which add to administrative workload. So if BMI's engagement with CTS goes beyond advisory work, trade agreements, proper structure and documentation, and also legal advices will be essential. So the next slide talking about our recommendations is to maintain independent CTS should work with multiple clients, take its own business risk and have no authority to sign contracts on BMI's behalf. No BMI staff in Sri Lanka should conclude contracts. All agreements should clearly state that CTS cannot bind BMI and that all strategic and management decisions remain in France. We also suggest limiting physical presence. BMI staff visits should stay below treaty schedule, so avoiding any fixed office or dedicated workspace. Finally, if a branch or subsidiary is open in the future, it must be registered and follow corporate tax rules. A subsidiary model could help limit liability. So, in conclusion, in short, so under the Sri Lankan France DTA, BMI is unlikely to face Sri Lankan tax if CTS remain independent and no permanent establishment is created. But carefully management is essential to avoid any inadvertent tax exposure. So this is the end of the presentation. Thank you for
Right. So no, I mean, question is that BMI, they are engaged with the Sri Lankan companies to do some sort of marketing research. Is there any tax implication on that? No, because there is no relationship because the Sri Lankan company is providing services to foreign parties. Whether Sri Lanka company is liable for tax?
Yes.
It could be liable, but as per the tax law, being services rendered outside Sri Lanka. In Australia, to party outside them to be considered because they do only market research and giving them solutions or they're giving a report to them. They are not taking any part of the decision making process. What they are doing, they are entirely making a services to party outside Sri Lanka. Then that party has to take a call. I mean, they have to take a decision on the basis of the report. Therefore, the report, the outcome of the report, the service is consumed outside Sri Lanka. Therefore, that income is tax exempt to Sri Lanka. And thereafter, you have to analyze the three options they are going to evaluate. One thing is what is that? Agency arrangement. Second thing is physical office. That means just like physical presence in Sri Lanka. So then branch or the could be branch or whatever thing, right? So then there is a triggering of fee. In case of the agency base, you have to mention that if it is a dependent agent, yeah, there will be a permanent establishment on that profit. They are liable, but this company, the branch company, is liable for Sri Lanka tax. Second thing is, if there is an independent agency, it won't be the case, right? So only that services payment, royalty, that type of may be liable for tax. But if there is a branch office or the physical office, they are going to establish a physical office here, then definitely it's a fee, it's liable. But it gets the subsidiary company. Just because of having a subsidiary company, it doesn't create a permanent establishment. But there's a chance to have a fee if they are controlling that business too. That subsidiary sending the employees, consultant, or dependence agents could be created. Agency-based permanent establishment could be created through the subsidiary company. But just because of the subsidiary parent, there won't be any permanent establishment. Right? That area should be covered. Right. That is 14, right? Thanks. Who else? What is that? Group one? Simon, 30 minutes. Apply out. Apply out. Any guys in there? You start. In Sri Lanka. She's our group and I will discuss brief introduction of nature of this selection. So, social is a tax company and it has entered into a contract with Sri Lanka and it is a Sri Lankan entity to conduct the oil exploration in Sri Lanka in Mana area. In this case study, I will highlight some key components. One is Sri Lanka based USD 200 million to oil for exploring and report on potential oil reserves. And oil states a vessel on Sri Lankan water territory and two employees are on board in that vessel. And oil handle the extraction and sale of the oil. And Sri Lanka pays royalty to the Sri Lankan government. And this picture I will describe how to understand this key points. Then I will like to summarize the person continue first. Application of Sri Lanka and Denmark under Article 5 defines the permanent status there's a fixed size of business in Sri Lanka. We can recognize that there is a permanent status and specify there is a base of management and service
placing factory and also no high oil gas, any other place of extraction, natural resources, and agriculture, farming, state plantation, and building site of construction, assembly, any project exceeds more than I can recognize as there is a permanent establishment. So within this company oil has fulfilled two criteria. They are mining and any place for the extraction that point as well as building site of construction has to be protected. If the project is more than 6 foot, so we can recognize as a permanent establishment.
My part is profit calculation of oil company. The scenario explain that this company is with the really situation, then this situation the company applying the normal tax rate of Sri Lankan government. Therefore, investment rate one be applied to the normal tax rate 30% for the discount tariff. As part of that, I briefly explain how the Denmark EPA Article 7 mentioned the business public oil taxable Denmark unless the PE in Sri Lanka. If the PE is Sri Lanka rising of it, attributed to that PE. That's been Denmark company completed 2 years. Apply the Sri Lankan tax rate 7%. But that means that case I mentioned the royalty. The royalty is CM company paid to Sri Lankan government. Therefore, this not liability oil for oil company was exposure. But that what are the implementation of the applicable Sri Lankan Act to the this company? Firstly, section 7.3 and 7.6 apply the section 4B. Non-resident company liable for income tax. They are source of income. After section 7C. Explanation equal EXP and different PE are subject to income tax. For that, the source of income section 73 clearly mentioned the agreement of service promoted in Sri Lanka. That's considered Sri Lankan source income under by what
About advanced personal income tax. They are working including projects, including the instrument test. They are working more than 180 days. Here is solution the executive voice sessions. Acceptable number one. Here, we go including one dash between 250,000. Then advanced plus that's rate is table that's table number one. Here, it is 8,000. After that, payment such as bonus, medical conditions, so in the table number 2, here the total regular employment 1.8 million is in some payment is about 1.8 million. Here, so that's like the some table, table number 2. Then DTA agreement is Denmark personal income tax. We can use this such income tax as credit. So that is the beauty. So I would like to make conclusion and that we with the permanent establishment requirement in Denmark, Sri Lanka, ETA. So Sri Lanka can tax thing of the E and the Article 7 of ETA. Also, OE should register in Sri Lanka, then to department and file advertisement with proper file records. Also, when consider about double tax release, Denmark will allow the permit tax rate to avoid double taxation of the same income. So, when we consider about also future is the royalty is fee with attract extra taxes, extra properly.
Also, then consider about the key rate correct. Careful tax planning, then reading knowledge, and vital for management preferred to take risk. Then also we set some start to summarize our conclusion for that purpose. And this is the application and
Right, so, first thing is, that you are correct that Denmark company, they are coming for Sri Lanka for the extraction of oil. So that is separately addressing the Denmark agreement, says extraction. So under that, there is a permanent exception created. The profit attributable to the permanent exception liable to Sri Lanka tax. That's correct, right? Second thing is, the employees in Sri Lanka. So, they are liable for Sri Lanka because that employment is exercised in Sri Lanka for a period of dependent person, professional name. Right? So employees are resident. They are liable for tax in Sri Lanka because they are exercise employment in Sri Lanka. So they are not income tax law and as well as DTA. DTA are three provision apply when second apply when why? They are staying in Sri Lanka more than 103 days. So breach. So then they are liable for Sri Lanka tax. But up to 183 days they are non-resident. So table 1 apply non-resident table apply period. Because they are not, because table 1 is designing using that 1.5 million tax the tax free allowance. Personal amplifier and non-residents are when table apply. Thereafter they can apply for table 1. That is this. And other part is what is this royalty payment to government? Is it subject to WTO or not? एक पे का नहीं लेते एक लोकल लेकिन एक श्रीलंकन कंपनी का रेजिडेंट पर्सन पे टू श्रीलंका गवर्नमेंट अन्य का हर दिन क्या एक लेवन है ओ इधर क्यों है क्यों है एक नाम बलानी देखिए ना क्यों है and then again, because royalty is not paid to the non-resident. Royalty to Sri Lanka government. WSA especially government person WSA apply. Thank you. WC apply, 40% apply. Understand no reasonable apply. Rent का भी लंका है क्यों नहीं होना दाया है ये होना दाया अभी DTA rate एक आदमी बाबा इधर आ लगा देखो ना ला मेरे को लगा ये कौन सा है How did you know that? Sorry, that's me. Diamond. I did that. Don't have it. They Kashim online they. Assignment number 2. Five members. Then you can start. Assignment number 2, right? Hello.
Yes, sir. Yes. Good morning. Good morning, sir. Assignment number is number 12.
12, right? Yeah,
Yes,
12,
sir.
right?
Yes.
Okay, put your camera on.
Okay, sir.
You can start.
Sir, I hope you can see the my screen.
Yeah, we can see you.
Yeah, okay, okay. In first you can start. Take the control and
Good morning, everyone. Today we are being discussing the tax exposure of Global Mineral Limited in Sri Lanka, focus of international tax principles and compliance tax law. Global Mineral Limited is a mobile telecommunications service provider based on Philippines. One of its key subsidiaries, Global Electrical Lanka Private Limited. Commonly, we will explain as the GL as in our presentation, which is location in Sri Lanka. During the year, GL made a urgent payment of 500 million for service on behalf of GMT branch of India. GMT later reimburse the objective of our report is to state the double tax agreement between Sri Lanka and Philippines. And my next thing will explain the status of tax and tax liability.
Thank you, Nifas. So, my part is to explain about the residential status and tax liability of the GMT. So, GMT is an non-residential entity. It is incorporated and managed from the Philippines, and so it is only taxable in Sri Lanka on the income source on Sri Lanka income source. So, under the Internal Revenue Act, income is considered Sri Lanka source if it's linked to service performed, business conduct, or payment made by Sri Lankan resident or permanent established. So in our case, that GEL transaction was connected to the MTs and Indian branch, not to the operations in Sri Lanka. Also, there is no permanent establishment for GMT in Sri Lanka through GEL. So therefore, according to the both Inland Revenue Act and the Sri Lanka Philippine DTAA, this reimbursement does not create Sri Lankan tax liability for GMT. So then my colleague will explain about the next part of the presentation. Udayanga.
Thank you, Gayan. Now talk about the permanent establishment. Under the Sri Lankan and Philippine double tax agreement, that permanent establishment is basically a fixed place of business that through which the company carries out its activities. In this scenario, when we come to the company incorporated in Sri Lanka, that Global Electronics, we might think it could be considered as a permanent establishment of the parent company in this Philippines. But the agreement makes it clear just because company is subsidiary and that alone doesn't make an permanent establishment. A permanent establishment could exist of the subsidiary act as a dependent agent, meaning that's mean it's a regularly signed contract on behalf of the parent, or if it's a work almost entirely for the parent, or if the parent directly control its activities. In this case, subsidiary company doesn't regularly act on the behalf of the parent company because that payment in question was urgent one-time transaction, not a regular activity. So legally and practically, that Sri Lankan company cannot be treated as a Sri Lankan company's permanent establishment under this agreement. So in next slide, Dan, can you move the next slide, please? Then we need to talk about that service fee reimbursement. Here, what happened that Sri Lankan company GEL paid 500 million Sri Lankan rupees in service fees on behalf of the branch in India. Later, GMT, that Sri Lankan company reimbursed to subsidiary, Philippine company reimbursed to subsidiary for exact same amount. Importantly, there's no markup, no margin, and no profit, just only pure cost reimbursement. According to the Sri Lankan IRD Act, service fees are usually treated as a business income, but in this case, Sri Lankan company didn't earn any income because it wasn't provided a service. It was only making a payment for GMT, that Philippine company, Indian operations, and then getting the money back. From the parent company, GMT side, the reimbursement is also not income source in the Sri Lanka because the original expenses related to India, and payer is a foreign entity. The main risk is in this here miscalification. If the records are unclear,
this could mistakenly be treated as a service income or even benefit in kind. That why it's so important to have a clear agreement and proper documentation between the group of companies and avoid the tax misunderstanding. That's it. Then my friend Somudra will continue the presentation. Right.
Thank you, Lanka. Let's move to next slide. Now let's look at how the double tax avoidance agreement between Sri Lanka and Philippines applies to our case. The key principle under Article number 7 is that business profit of non-residents, in this case GMT, can only be taxed in Sri Lanka if they are attributable to a permanent establishment here. Since we are already established that GE is not a EE of GMT, Sri Lanka does not have taxing right over this profit. As per Article number 5, reinforce this P requires a fixed place of business or dependent agent relationship. Our transaction was a one-off reimbursement with PL operating independently, so this condition is not met. Under Article number 9, transaction between related parties must follow the arm's length principle. In our case, the reimbursement was done at cost with no markup, so it's meet the requirement. Other treaty articles on dividend, interest, and service fee are not applicable because this is simply a cost recovery, not an income generating service. Finally, article number 24 on non-discriminational means we cannot impose a tax burden on a foreign company in a situation where a local company would not be taxed. So under the DTAA, there is no Sri Lankan tax liability for GMT in this transaction. Next, let's discuss transfer pricing consideration. Can you move to next slide? Sri Lanka follows OECD aligned principle, which required that related party transactions are conducted as if they were between independent parties. This is the arm's length principle. In our case, the reimbursement from GMT to GEL was at actual cost with no profit margin for markup. That aligns perfectly with the arm's length standard for cost recovery arrangement. However, compliance isn't about the pricing, it's also about documentation. We must have a formal reimbursement agreement, invoices or remittance advisors, proof of payment, and board approvals. Without these, the island revenue could reclassify the transaction as taxable income or even impose penalties. The OECD guideline also recognized that now I'm invited to Farhan to continue our presentation.
Hi, thank you. Thank you, everyone. Okay, my part is basically conclusion and recommendation. So as a conclusion, we can say that no tax liability on GMT Sri Lanka, and there's a high risk. There's some risk in PA creation and reclassification. At the recommendation, our point is like we need to document all the intercompany transaction and agreement and use the point number section number 107 to tax clarification, and need to develop a group reimbursement protocol, and finally review the related transaction on a timely basis and mitigate risk. That's also our point.
Right. So actually, in this the assignments, I have focused three areas. First thing is that Philippine, the company, they are setting up. They are going to plan setting up a subsidiary company in Sri Lanka, right?
Yeah.
Second thing is they have opened a branch office in India, right? So Sri Lanka, when the subsidiary shall not be treated as a permanent establishment unless if there is an agency based relationship is created, right? It could be under the agency based PE, but there are no much information given. But that has to be highlighted. Otherwise, they are not liable for Sri Lanka tax because it's an independent two entities. just because of having subsidiary and parent relationship, there won't be any triggering of P in Sri Lanka for this between company, right? So that's the one part. Second part is that Sri Lanka company is going to reimburse some expenditure, which is or the pay some expenditure to India branch, which is related to India branch of base. So under section 73, 1C, we say if the Sri Lankan person or the resident person make a payment to non-resident person, it shall be treated as there is a source in Sri Lanka. But if it is a reimbursement of permanent establishment of a non-resident person who is having outside Sri Lanka, it shall not be treated as a source in Sri Lanka. That's what. So I will not keep in the margin. That is not applicable, but that is the point what I have tested in this case, right? So if I mean the section 73 1C says if the resident person make a payment to non-resident person, it shall be treated as a service fee and this shall be treated as a source in Sri Lanka. But this payment is purely for the settlement of expenditure made by a permanent establishment non-resident person outside Sri Lanka. Therefore, it shall not be considered as a source in Sri Lanka to Philippines. Right, that should be highlighted. Right, especially say otherwise, other than the payment on behalf of this lunch budget goes. Right? So, but you have mentioned that if there is no source in Sri Lanka, that's fine, but that is the section that should be caught. Should be highlighted there. Right? In your report, definitely it should be mentioned. Okay? So that's the second part, and anyway, that India branch of it, that property is not happening in Sri Lanka, they are all free tax. Okay? Okay, guys. Thanks.
Yes, sir. Thank you very much.
Thank you, sir.
Thank you.
Two days, maximum 2 days. Take group
Interaction part, company background and transaction audit, legal framework, and comparative analysis and conclusion and recommendations. Then I will give a brief introduction for our analysis. Companies, sunshine holiday resource. Okay, focus on the sunshine holiday resource private limited. Sri Lankan company engaged in managing hotels and villas. While the business has solid presence in hospitality sector, this company is facing pressure due to high gearing ratio. That means which has led to significant debt servicing costs. To address this issue, the company considering two capital restructuring options. And option one is sell investment property to Delhi Resorts Private Limited. And they have an idea to prepare loans from that. And second option is transfer equity shares to Delhi Resorts. With buyer take over the company's debts. That is second option. A major consideration here is tax exposure of sunrise holding resource and shareholders. Those shareholders are provider incorporation and park incorporation. Both are incorporated United Kingdom. Since there are cross-border transactions, both England Revenue Act and both England Revenue Act plus Sri Lanka, UK. Double tax avoidance agreement should be considered, which is in this analysis. So this forms the basis of our analysis, and more will explain by Madhusha.
Let's talk about company background and transaction overview. The Sunshine Holiday Resort is a resident company operates hotels and villas with its registered office in Market. As you can see in the screen, the ownership is split among provider 24%, partner 25%, and partner 51% ownership. The company is facing financial difficulties due to a high gearing ratio and heavy debt servicing costs. To address this, a consultancy was appointed, and the resort has submitted to acquire SHR. There are two options under consideration. First option is an asset transfer, and second option is a share transfer. Today in our presentation, my two colleagues, Romali and Melody, will explain you to those options. Now, what explain the legal sunshine holding source capitals instructing two foreign shareholders, provider information and corporate information, as well as unreserved representative for local shareholder. The legal framework based on two key resources, Inter Revenue Act number 24 2017 and Sri Lanka UK double tax ordinance agreement. A Sri Lanka resident company selling land or share must pay 10% capital gains. The Sri Lanka UK double tax avoidance agreement prevents double taxation of over 50% of value fees from land. Sri Lanka can share gains from UK shares. This principle in two options. Option one is land transfer. Option two is share transfer. Land transfer 10% DDT applies locally for each shareholders, not affected. Share transfer, Sunshine Holiday Resort is a real property holding company. Sri Lanka can tax capital gains from share transfer by UK holders. Land transfer affects only the company locally, but share transfer affects foreign shareholders through Sri Lankan tax. Tax implications of the land transfer, which is option under option one is the child limited pension transfer one of their land and building through Resort Limited, which is another resident company. These proceeds from this there will be used to settle the high interest loan of the company. Importantly, this transaction does not change the shareholding structure. Then moving to tax treatment. According to section 3 and 8(1)(c) of Inland Revenue Act, this transaction results in capital gain. Then is the land and building treated as the investment assets, investment income. The applicable CDP rate is 10% on the net gain. The capital gain calculated as the difference between sales price and the cost base. If the land owned by before 30th September 2017, the market value considers the cost. Moving to compliance and strategic impact, HR should file CD and pay tax within 30 days. 30 days after the end of the month when transaction occurred. Then there is no any foreign shareholding. So finally, we recommended as the preferred option is one because this transaction helps to reduce debt and improve cash flow of the company without changing ownership. I'm moving over to you. In option 2, we focus on the transfer of equity shares in Sunshine Hotel Resort by its UK shareholders, provider and partner to Lily Exports. First, under the Inland Revenue Act, capital gains derived from the disposal of investment assets, including shares in a resident company, are taxable in Sri Lanka. Since SHR is incorporated here, its shares are considered Sri Lankan source assets. Therefore, when Chloride and Parker sell their shares, the resulting capital gain is subject to capital gain tax 10%, calculated on the net gain after deducting the cost base and allowable expenses. Next, the Sri Lanka UK taxation avoidance agreement plays a key role. Article 13, Section 4 confirms Sri Lanka's right to tax these gains as they rise from shares in the Sri Lankan company. Article 21 ensures that if the UK also tax the gain, the tax credit will be provided to the Sri Lankan taxpayer. In summary, for option 2, the tax exposure for the UK share is clear. They are liable for 10% capital gain tax in Sri Lanka, but the TTA ensures that they won't be taxed twice on the same again. Next, answer will explain about the conclusion.
Conclusions of finding some of the content option 1 that are is more clear and most effective and excellent restructuring strategy. It provides immediate liquidity for repayment, maintenance, legal and tax exposure. Then reduces compliance burdens by reducing fiscal code, which can strengthen its financial system while avoiding unnecessary complexity, ensuring smoother transaction towards long-term stability and reconciliation. Donations, first of lower tax liability, long exposure and compliance, administrative simplicity, operational continuity, immediate reduction, reduce disputes, one-time transaction, equity based. End of the
Any question? Doubling and tax rate. What are the applicant tax rate? Huh? 10%? So it's a realization gains to what? To whom? So first instance, there are the two transactions, right? Two nature of transaction. First thing is, so all these are full stories. So what is that they are having hearing whatever thing. For the tax point of view, what the point is, they are going to dispose one investment property. So it is land or whatever thing. So capital asset keep as part of an investment. Realization gain on the investment assets to resident company is liable for capital gain tax. That's correct. Rate is 30. Because it is company. Right? And wrong, right? Second thing is disposal of shares. Realization of the shares. එතන දෙන්නෙක් ඉන්නවා. එක්කෙනෙක් තමයි two shareholders ලා UK resident, one shareholder Sri Lanka resident. It's a company. Sri Lanka resident එකන company. Again, realization of shares, capital assets, part of investment. Shares කියන්නේ තේකා ගැටෙන investment realization gain to ordinary resort is tax at 30%. Right? Second thing is shareholding is the two companies outside Sri Lanka, UK. So UK DTA apply in isn't. So whether Sri Lanka have the taxing right or not? DTA balu? Kivu? UK Sri Lanka DTA kivu? Tina lo? Pen number? Balu na? Balu na? Ada angko kya? Ah? Balu derun na? Derun na balu na? So as for the UK Sri Lanka DTA, we don't have taxing right. It goes to UK. අපේ ඒගොල්ලන් ඒතකොට ලංකා ඩිස්පෝස් කරන එක ටැක්ස් එක නෑ නං. ඒ as per TDA. ලංකාවේ law එකේ domestic law එකේ කියනවා but because of the DTA provision so elimination of capital asset බලන්න ඒක කියනවා special shares ගැන කියනවා UK DTA. It is tax only in UK, not in Sri Lanka. We don't have tax. You can just come and report other than. Right. Hey, one percentage next year. 6, 9.
and improve mental health services in India, so that they have appointed estimator responsibility. Under that, they have done two scenarios. One is Indian company regarding the mental health issues. The second scenario is a Malaysian company that they have provided consultancy advisory. As a special scenario, this TCL company has expended about 100 million worth of computer. So, this is other case studies other case study, the tax application will be explained in the Minister of Health, National However, the tax avoidance agreement can override overseas from Switzerland has further establishment in Sri Lanka because they have business staff. They are both split and principal CEO. Now that's from 30%. Capital asset like if people qualify for since they are related to Sri Lanka, operations are not subject to economic tax, but they have service outside Sri Lanka may attract disability tax 40%. On the other hand, APL managed to provide service rewarded without any physical presence in Sri Lanka, so they do not have permanent establishment. However, because of their platform issue in Sri Lanka, their income is considered Sri Lanka sources. Payment made to attract importing tax at 50%. Unless the Sri Lanka manager DCS reduces tax rate. TCS has permanent establishment in Sri Lanka.
is taxed at 30%, while ABS has the lowest level tax establishment, but basic income tax income is determined by the base of service or interest rate. Direct application of property tax at pay alongside with double tax avoidance agreements is essential to ensure the clear business and avoid penalties. Now, focus on the tax declaration for the serving service operation in a permit establishment. Yes, operations of this is Lanka for a final project. Even though time period is short, but the physical presence of an office, staff and implements strongly indicated the existence of a PE under the Sri Lankan tax law and the applicable tax agreement. With the PE, ECS is liable for corporate income tax in Sri Lanka on profits attributable to that PE. The from contract value of USD 185 million, the estimated profit is USD 85 million, and at a 30% tax rate, the liability amounts to USD 25.5 million. TCS can claim deductions on USD 90 million in operational costs under 20% capital deductions on USD 10 million in capital expenditure benefits available only under the PE taxation. In establishing a PE instance in local profit based taxation and compliance with the deductibility advantage. So, next we analyze the tax obligation of which is collection property divided establishment in Sri Lanka, there is no physical presence such as office, branch, this means of tax business under the BSAA. However, $5 million payment for the development and maintenance of a digital platform that falls under the definition of technical piece of Article 13 of Malaysia tax rate. Tax rate for which is lower than the domestic tax rate of 20%. As a result, it is obligated to $500,000 as the total tax Sri Lanka as an officer, mobile billing card, we have paid for police, but that's not which and fees